Hello everyone, and welcome to this special panel session on central bank research. I'm Andy Haldane, the Chief Economist at the Bank of England. Let me start just by thanking colleagues at SEBRA, not only for hosting this session, but for bringing together over a number of years now, central bankers and academics and private sector economists to discuss some of the biggest issues facing the economy and facing central banks just at the moment. We're hosting this panel to mark the launch of our new Bank of England research agenda, or more accurately, the Bank of England agenda for research. I've transposed the last two words to allow me to abbreviate it to BEAR. And today is about discussing not just zebras, but bears as well. The BEAR was published yesterday. So for those interested, it's there on the Bank of England's website. It's a nice, short, and I hope clear document setting out our stall on what issues we intend looking into, what questions we intend asking and answering ideally over the next 5 years or so. They're grouped, I hope helpfully, into 5 key themes. One of those themes, the monetary toolkit in its many and various forms. Ben, of course, has been discussing one aspect of that in the previous session. The other 4 themes are the ones we're going to focus on over the next hour, with our incredibly distinguished panel of academic experts. I'm really grateful to them for taking part and offering their thoughts and reflections on what form our research agenda might most usefully take. Let me introduce them very briefly before passing across to them. So first up, we've got Andres Velasco from the LSE. He'll be discussing a number of the themes, in particular issues around the open economy. I'll then turn to Viral Chaya from NYU, where I'll be talking issues around the prudential framework for financial stability. Third up, we have Daryl Duffy from Stanford, and Daryl will be talking about the future of finance in its many and various forms, in particular issues around retail payments, I think. And then finally, we have Diane Coyle from Cambridge, and Diane will be discussing the final theme, the so-called transformed world, which is the various structural megatrends in the economy, including, of course, the effects of COVID. Now, this panel, I think, is a great example of just the sort of collaboration between central banks and academics that we hope that the BEAR is able to catalyze. The plan is that our 4 panelists will give a short presentation. Hopefully there'll be enough time left at the end for a bit of Q&A. So please put some questions in the box. I'll try and get through as many of those as possible towards the end. But without further ado, let me pass the floor to Andres to discuss the first theme, the open economy. Andres.
Thank you very much. Thank you very much, Andy. Let me share my screen here, if I may. Hold on one second. There we go. All right, thank you very much for this invitation to Zebra to discuss BEAR. Thanks to the Bank of England. I promise to hold no grudge for the fact that they misspelled my surname on the program. Clearly, this is an exciting research agenda. It contains many, many issues. I wish I had the time to go into all of them or even a large subset of them. But time is short, and there are only 3 that I would like to focus on. I'd like to say a little bit about the international context and the role of the dollar as a reserve asset. I would like to say something about the state of the international financial safety net, and then at the very end speculate about new trade patterns post-COVID and what this means for macro policy. All three are in the bear, along with many other things which regrettably I cannot discuss. So let me begin with safe assets and the dollar. The starting point has to be, of course, that the dollar remains unchallenged as pretty much everything you'd want a major world currency to be. It is used for reserves, for debt issuance, for loans, for invoicing, et cetera, et cetera. And the reasons why that is so are pretty well known. I will not discuss them at great length. It may just be that there's, a big natural monopoly, which is hard to dislodge. There's a lot of inertia in invoicing. The US has deep capital markets. There are not that many safe assets in currencies other than the dollar. And last but not least, the dollar is a great, or at least has been in the past, the jury may still be out in this crisis. It has been an asset with all the right cyclical properties, because the dollar tends to appreciate during crises. So at times of stress, if you have dollars in your portfolio, you're doing pretty well. As a result, we cannot be surprised if the dollar remains king and there's no obvious challenger, not quite the euro, not quite the RMB or anybody else. But there are two things that we need to think about when we think about the role of the dollar. One has been discussed at length, one has been discussed maybe a little bit less, and I'd like to mention all of them. The first issue is familiar from the research of Elaine Ray, and I think she's set the stage, but there's a lot more than we can research and think and understand. It is pretty clear that the role of the dollar as a safe asset international is key to its role as the world's reserve currency. But one pretty obvious fact is that the share of the US in world output is shrinking. Now, the US economy is not shrinking, at least not for long, we hope, in absolute terms, but it is shrinking in relative terms. And as long as the share of safe assets within US GDP is rising, then the US is in a fairly strong position to keep supplying safe assets to the world to the extent that the world needs them. That may not have been fully the case because a scarcity of assets that are safer in dollars may be one of the explanations of why interest rates worldwide are so low, and I will return to this point. But the other big question, of course, is whether this can remain as a trend forever. And Elaine Ray and Pierre-Olivier Gourin-Cha and a few co-authors, of course, have termed this the new Triffin dilemma, alluding to the old Triffin dilemma back in the day of the dollar as a reserve currency under Bretton Woods with fixed exchange rates. So the big question is, if indeed the world behaves like that picture on the right suggests, will the US economy and will the US supply of safe assets be large enough? And if not, what are the effects for stability? This is a well-known issue, but I think the fact that it's been stated clearly does not mean that we really know its implications for the future of world financial and monetary stability. The issue number two that worries me a little bit more, and this is a hugely controversial one, but let me give you my take on it, is that safe assets from the US look pretty safe today. They've been pretty safe over the last few decades with a few caveats, but they may not necessarily be safe forever. I'm a big admirer of the work of people like Ricardo Caballero and Emmanuel Fari, and again, Pierre-Olivier. Their model of the world monetary system and of the safe asset scarcity, I think, reveals a lot of the dynamics at work in the world economy today. But they emphasize, and of course they're not the only ones to emphasize, that it is fairly easy to keep issuing reserve assets or safe assets today, because there are two conditions I discussed at length that are quite special, or to the extent that they're special, we should keep an eye on them. One is, of course, the fact that the rate of growth has been higher than the real rate of interest, not because growth has been high, but simply because the rate of interest has been so slow, which allows you to spend more today without necessarily, and I emphasize necessarily, having to issue more taxes tomorrow. And of course, the fact that the nominal interest rate is zero makes issuing a dollar and issue a short-term treasury bill pretty much the same, that both assets become close substitutes from the point of view of investors. And this makes not only the issue of treasuries, but also the growth of the balance sheet of the Fed fairly easy to accomplish without much of a tremor. Now, the $1 million question, actually the $1 trillion question, is whether this is a permanent or a transitory state of affairs. Ken Rogoff recently, in one of the Princeton COVID lectures, made a statement which I think is worth pondering on. He said the world and the US are betting the farm on the fact that these interest rates will remain as low as they are forever. And in particular, and this is something that I've done a fair bit of research on, one has to worry about the issue of multiplicity and multiple equilibria. I'm a macroeconomist who's done a lot of work on emerging markets, and it's very hard to think about emerging market finance without thinking about multiple equilibria. Multiple equilibria typically come from a shortening of maturities. And as Ben just pointed out in his keynote a few minutes ago, one way to think about all the unconventional monetary policies in the last crisis and in the current crisis is a dramatic shortening of maturities. And when we have much shorter maturities, it is quite easy to begin to envision scenarios in which investors get cold feet and they simply refuse to roll over those maturities, interest rates spike, et cetera, et cetera. I am not saying this is going to happen in the United States today, but I am saying that there are underlying conditions which make this question worth studying. And in particular, there are a couple of things that we should be studying. One of them is that it is not obvious what the connection is. And this is, you can say about this in the US, but you can say this about any country. And Ben also discussed this in his remarks a few minutes ago. It's not obvious what the connection is between the stock of debt and the probability of a run. Because if you have 100% of GDP in debt and you reduce it to 90, does that mean that a run has been ruled out? Of course not. The second thing that we need to think about is fiscal capacity. We all understand and accept that the underlying fiscal capacity of the US is what makes the dollar a safe bet. But of course, fiscal capacity is related to political economy. And I don't think I'm being disrespectful if I say that the quality of US politics is not quite what it used to be. I'm from Latin America, and the US looks increasingly Latin American. And as a result, I think that also raises questions about how safe American assets or other key assets will be in the future, on what the implications for macro might be. So that's issue number one that I wanted to mention. Issue number two that I wanted to mention, and I talked a little bit about this yesterday, so I will be telegraphic. This is also in Bear, is the state of the international financial safety net and its implications for capital flows, exchange rates, and monetary policy. This picture here is based on data from the Bank of England, but it was published in the G20 Eminence Person report a couple of years ago. It describes the components of the international safety net. Once upon a time, the IMF was big, no other component mattered. More recently, the relative size of the IMF has gone down because the world has grown and the IMF has not. And other kinds of arrangements, like regional arrangements and swap arrangements, have risen in importance. But of course, this means that countries are excluded because not everybody is in a regional arrangement, and swap arrangements are limited to a handful of countries, and only to 4 emerging market economies, not to more. And I think this has been fairly evident in the current crisis, because the COVID-19 shock was external, it was exogenous, it was transitory, it was global. The first 3 suggest that countries should have dealt with the shock by running a larger current account deficit. Private firms are running a deficit, the government is running a deficit, maybe private households are saving a little bit more than they used to, but on net, you would have expected, if you did not have an external financial constraint, that the current account would have become larger. And in fact, what we observe is mostly the opposite. This is from the most recent IMF report on the subject. Advanced economies, which began with a large current account deficit, are going to keep or enlarge their current account deficit. Oil exporters, of course, are in a category of their own, and there you see surplus is shrinking. But for emerging economies, which began with a current account deficit, whether big or small, they are moving into balance. Brazil is a good example. It began with a deficit of about 3 points of GDP. My own numbers, based on talking to Brazilian economists, that Brazil will have pretty much a balanced current account this year. That's exactly what the doctor did not order, which suggests, I think, that there's a big asymmetry at work today in the world. Advanced countries are doing whatever it takes. Emerging economies are doing whatever they can. The world is awash in liquidity, but we don't have the mechanisms and the institutions that allow us to recycle enough of that liquidity toward EMs or toward all EMs. The larger systemically important EMs, some are covered, some are not. And one way to think about this is simply, what are the mechanisms for increasing the ability of international financial institutions to lend? And parenthetically, this is not simply an exercise in altruism, it is an exercise in self-interest from the point of view of the major advanced economies. Because if you put China in the picture and you do PPP calculations, emerging economies today are nearly 60% of world GDP. And therefore, what happens to emerging economies is not simply important on social or humanitarian grounds. It is very much important from the point of view of aggregate demand worldwide and growth. And given that enlarging the capital of IFIs has been hard, that SDR issuance has been controversial, I think the time has come for other mechanisms, maybe for more leverage, for more creative finance, to increase the lending capacity of IFIs. Happy to return to the details if we have time. Last but not least, and I will be very brief here because this is very highly speculative, and then I will end. It is an interesting observation, to some extent a conjecture, coming out of COVID, I hope we're coming out from this crisis, that there are three apparent likely consequences of the crisis for the world pattern of production and trade. For some countries, including the US, it's become politically attractive to have some manufacturing at home. The president of the US told the world last week that the US would no longer rely on China for medical supplies and medical equipment, for instance. It has made some labor-saving technologies much more common. They were available, but now we've been forced to use them. And once we have, firms are beginning to find that they like them. And last but not least, distance working, of course, that's what we're doing right now, has become much easier. One way of bringing the three facts together, and Dick Baldwin has done this in a recent paper, is to conjecture that manufacturing is increasingly going to become jobless. Of course, that's a bit of an exaggeration, but you get the point. And services are going to become freely tradable. So maybe the great growth in emerging markets in the next few years will not come simply from manufacturing for people in the US or the UK to buy goods at the local shopping mall, but maybe trade and services will become the next engine of growth and of world trade across countries in the next few years. This has huge consequences for development. Historically, countries went from agriculture to manufacturing to services, but the real leap forward came with manufacturing. Perhaps that's no longer feasible. But, and this is where I want to invite some speculation and maybe some research, it has big consequences for macro as well. It may induce transitional unemployment as some kinds of manufacturing become even more jobless than they have been in the past. It may cause a change in the way the exchange rate operates to induce external adjustment, because a devaluation deflates the value of wages that may no longer be feasible or desirable. And last but not least, the capital flows internationally may change because the pattern of investment outside the rich world will change. All of this is fascinating. All of it is speculative. But even if some of it changes, it will have big implications for monetary policy. I probably took too long. Thank you, Andy. And I will stop there.
Thank you, Andreas. Absolutely fascinating. A really rich set of questions there and discussion. And apologies for the typo. Let me pass very quickly to Viral, who's going to discuss the prudential framework. Viral.
I think, Andres, you might have to stop your screen share.
Apologies. There we go.
No problem. Great. Thank you, Andy and Ricardo, for this opportunity. I find the topics in the prudential framework quite rich, and I think I'll just give a very quick rundown of some of the themes, and then, like Andres, focus on three issues that, partly based on my research, partly based on others, I think may be worth taking on board in greater detail. So the two-page note focuses on several issues. I think there are 6 issues. I'm covering only 4 here that I found the most appealing. One is on stress test modeling, especially given that stress tests have become the global benchmark in advanced economies for setting bank capital requirements. How should we use stress tests when you have a macroeconomic or a financial sector downturn? Should your scenarios get more adverse? Because that's what, unfortunately, the reality is when you are in a downturn. All macro outcomes are likely to be more worse than they were in good times. Or should you have erred on the side of more stringent scenarios in good times so that you can have some counter-cyclical relief in the stress tests? And I think a very important point is on the interlinkages between the financial system and the real economy. A lot of progress is being made here in understanding when you get a pass-through of monetary policy. And invariably, the primary result in most of the studies is that if you don't have financial stability, you don't get a healthy pass-through of monetary policy. Undercapitalized banks, undercapitalized shadow banks simply don't pass through monetary impulses. And even when they do, they end up passing it to the wrong ones. Now, even if you think about the stress test modeling, there are important policy interactions. Currently, most stress tests are based on solvency calculations. There is some attempt to factor in liquidity interactions, but I think that would be a natural second round step. Just the way it is for sovereign debt, so is the case for financial firms, that you get bad outcomes happening with short-term debt, in particular the risk of runs and multiple equilibria. And I think that would be a natural way to think about whether capital and liquidity requirements need to be thought of as a matrix. Perhaps better capitalized firms could hold lower liquidity and vice versa. And that could be an interesting exploration, because right now the capital and the liquidity regulations are working sort of independently of each other. And then there is the unintended consequences of low for long interest rate policies. I'll have much more to say on this. So let me just mention that I do think this is an important theme, because in a way, a lot of stress tests are thinking about macroeconomic shocks, but I think one has to also take into account policy-induced shocks themselves on how they affect the financial sector. There's a very nice section on supervision and more focused on microprudential regulation, I would say. But I think the focus on greater quality of data and operational resilience, especially on the cyber risk front, is absolutely spot on. we are just, I think, scratching the surface in research, especially on the cyber risk and how they can affect payment systems and so on. And finally, it's hard to think any more about financial stability without thinking about non-banks and their interactions with banks. And the two-pager focuses exactly on the right questions relating to insurance firms and pension funds, their growing role in the bond markets, as well as on mutual funds and exchange-traded funds who seem to be offering essentially very high levels of liquidity promises and easy redemptions. And there's a question as to what exactly do they have in order to meet these promises when the redemptions come due. So let me focus on three themes. The first one is on shadow banking. Some of the literature I'm going to talk about is on the last slide, which hopefully you can see when the slides are circulated. But more and more, it seems to me from the evidence and the research that the shadow always touches the feet, as they explain to children who are figuring out what a shadow means. And shadow banking seems increasingly ultimately putting the risks back onto banking. So let me elaborate. Bank finance versus market finance used to be thought of as monitored versus non-monitored finance. Increasingly, I think the view on this has to be taken that bank finance has an automatic stabilizer in the form of deposit insurance, whereas market finance is providing immediacy and meeting the demands for immediacy, but doesn't have this automatic stabilizer. And so when you get a stress scenario, take the COVID episode in February, March, the outbreak and the financial dislocations that took place. It was very clear that at least in the United States, all of this had to do with the corporate bond markets. There was a rollover risk. There was perhaps even a temporary freeze in certain segments of credit quality. Now, the main point is that, but that is not how it played out. It wasn't just an isolated problem in shadow banking. Most of the corporations that were reliant on the market finance had contingent contracts written with banks to draw down on credit lines. Now, when the aggregate risk rose in the form of the COVID outbreak, banks experienced massive corporate drawdowns on their credit lines. There was effectively a precautionary dash for cash. In fact, the intensity of this dash for cash was so severe. I document this in a recent paper that if you had done a stress test based on the global recession, you got a 1 month drawdown on bank credit lines that you would have anticipated in a whole year if we were experiencing something like the Great Recession. So I think this flow of the liquidity, implicit liquidity insurance from shadow banks is ultimately a claim on the banks. And I think the thought one has to entertain, and I think this has some relationship to the point Andres was making for the international financial system, which is that it seems to me that the central banks, being lender of last resort to banks and having these massive balance sheets, have probably created a tremendous propensity to issue these implicit liquidity redemption rights in shadow banking. You could call it bond market, you can call it ETFs, whatever these be. But all of these ultimately seem like put options in times of aggregate stress, because you get a freeze, you get drawdowns on banks. And I'm concerned that we can no longer just focus on banks in the thought that they were the ones where we need to stabilize. I think the entire shadow banking now seems like a claim on the put option of the central bank balance sheets. So I think this moral hazard means that we have to factor in shadow banks as prominently in our stress tests as we used to think about banks. Second, I have been concerned for most of last 10 years on the zombie lending problem in Europe. Of course, it goes back to the Japanese zombie lending of the 90s. My assessment is that Europe has experienced a lost decade of growth in many parts of Europe, just the way Japan did in 90s. because it adopted a roughly similar policy toolkit to deal with a full-fledged financial crisis. It adopted low rates, high liquidity, but combined with regulatory forbearance for banks, asking banks not to recapitalize themselves, but instead relying on either government guarantees or on accounting relief on absorption of losses into bank capital. Undercapitalized banks, also undercapitalized shadow banks, they simply don't lend well. They are more focused on not recording their and recognizing their legacy losses. So they keep distressed firms alive by doing evergreening or extending the maturities and pretending everything is fine. Perhaps this is okay as a stopgap measure when you get the shock in the first time, like the Lehman Brothers collapse or the outbreak of COVID. But when it evolves into a near permanent feature, you start seeing the real effects gradually play out. What I'm finding in my research, also in work of others such as Laura Blattner at Stanford, and a series of other authors in Europe, all studying different countries, is that zombie lending or evergreening has created low growth, extremely low productive, but heavily indebted sectors. Even healthy firms in these sectors have lost their pricing power and therefore don't find it profitable to make investments and employ labor. And that creates a deflationary pressure due to excess sectoral capacity. And what this has created, in my view, not recognizing the importance of financial stability in the transmission of accommodative rate and liquidity policies, is that it has created a cognitive cul-de-sac for low rate, for low for long policies. And what do I mean by a cognitive cul-de-sac? Which is, if you take the view that when you lower rates, you will be boosting growth and raising inflation, what lack of financial stability in the form of undercapitalized banks gives you is exactly the opposite. Low rates makes it easier to do zombie lending. Easy lender of last resort policies makes it easy to evergreen loans. And so that creates actually low growth and deflation. And when you observe that, instead of recognizing the importance of financial stability in the transmission of monetary policy, the central banks are pushing on a string and actually coming up with more and more unconventional tools, which unfortunately are making zombie lending even worse. My fear is that while perhaps justifiable in the short run to deal with the COVID outbreak, I have seen this play out in emerging markets. I've seen this play out in Japan, in Europe. My fear is that this will become the norm and the central banks are going to get trapped into encouraging zombie lending as we try to come out of COVID. I think that's going to have long-run consequences for growth, long-run consequences for health of the financial sector, and long-run consequences of low for long. So I think this is something that the stress tests may also want to think quite seriously about when considering the health of the financial sector. And the last point, again, this is going to cross a little bit with concerns that Andres was raising about the United States fiscal sustainability. Now, I think this is the elephant in the room as far as central banking is concerned. I think it's fiscal deficits. Having been in a central bank for 2.5 years, I know that it's not considered okay to comment about fiscal deficits too much, but I think we have to, because it's going to affect financial stability. There has been a decade-long expansion of government balance sheets in AEs as well as in emerging markets. There is no doubt that quantitative easing, while on the one hand an unconventional monetary policy tool to support growth, it has also been a tool to support government borrowing at low costs. And there is no way that so much debt could have been issued at the rates it was without the support of the central bank. So in one way or the other, it has been deficit monetization. Now, COVID, of course, given the scale of the shock, has led to very large increases in the fiscal deficits, especially in the AEs where they are doing whatever it takes. EMs have been more limited, as Andres mentioned, because they don't have that much fiscal capacity. They are already stretched to the hilt in many cases. And I can't help but think about what is the end game here. Will it be a fiscal dominance of monetary policy, as Sargent and Wallace have highlighted in their seminal work? Will it be a fiscal dominance of bank regulation, as is very typical in emerging markets, where you basically repress banks to buy government bonds because you need to soften the landing of the fiscal policy? Will that lead to financial and economic repression? Will private sectors actually start seeing a crowding out, as we saw perhaps in parts even in the post-World War II advanced economies? And if we do this, if we do stuff the bonds of governments onto the financial sector balance sheets, either through moral suasion or through explicit regulation, and the fiscal deficits do not remain in check, or if growth doesn't turn out to be as good as we had hoped, will that lead to a bank sovereign nexus and a doom loop of the sort we witnessed in the European sovereign debt crisis, and one that is, of course, very typical in emerging markets? Last point, I would also highlight that this has implications for inflation. Costs of government borrowing seem to have become unstable even for many advanced economies. If and when private sector wants to borrow again, and if they are feeling crowded out, what will be the outcome? If we see financial repression, we might continue to see deflationary pressures. But if we don't choose the path of financial repression and instead central banks monetize the debts, we might actually see inflationary pressures rise quite rapidly. And I think these are also some financial stability concerns that may be worth thinking about. Thank you, Andy.
Thank you, Viral. Three fascinating and actually very challenging, incredibly challenging issues for central banks there. Now, we're running a bit short of time, so I'm going to pass quickly to Daryl on the future of finance. Daryl.
Thanks so much, Andrew. It's a pleasure to be here. Exciting presentations. Let me get right down to it. As you say, we have a small amount of time, but you guys gave me a huge mandate here to discuss the whole future of finance, which is impossible in a few minutes. So I'm going to focus down quickly. When we talk about advances in the future of finance, the charge in your two-pager was related mainly to financial technology. And there's so much that we could discuss in this area, like robo-investment advising, or the advent of all-to-all electronic trading in bond and currency markets, or mobile trading apps like Robinhood, which actually had some pretty bad outages in the last couple of days. And machine learning has taken over in so many application areas. And the technology list goes on and on. The future of finance is really in flux on the technology side. But given the limits of time, I'm going to focus on the revolution that we are seeing in payment technology and the associated disruption of commercial banking franchises in the payments area and in deposits. Central banks are really grappling with some tough trade-offs here. In fact, we're going to be learning, and we have been learning a lot about this topic in the payment stream of presentations here at the Zebra. The key financial technologies in play are next generation fast payment systems that use bank payment rails with new technology, like India's UPI. Mobile payment apps, which need not use bank payment rails, like China's WeChat Pay and Alipay. New cross-border payment technologies that are displacing conventional correspondent banking. And BIS has a nice new piece on that just yesterday. And of course, the really big one, general purpose central bank digital currency. I didn't mention private stablecoins. I don't think they're going to amount to much in developed market economies, especially given the compliance issues. But Libra really changed the conversation last year. Libra heightened the perception that we can do much better. Central banks around the world are now really feeling the social pressure to address the quality and cost of payment services. Among the large developed market economies, the situation in the United States is the worst. In the US, total payment revenues are something like 2.3% of GDP versus about only 1.3% in Europe, Middle East, and Asia. And this is definitely not because of better service quality in the US, where payments are actually also quite slow and the user experience is not great. There's just a lot of rent taking by banks and by credit card companies, and very weak incentives to compete for payment services and for deposits. US deposit interest rates are abominably low relative to wholesale market rates. So there is a real zeitgeist that it's time to bring payments into the 21st century, even though we're already 20 years into this century. Among large economies, China has actually been leading the way on payment technology. For example, with the huge popular mobile payment apps, Alipay and WeChat Pay. Because Ant, the operator of Alipay, is doing an IPO right now, we have a disclosure just this week. And we know that total payments on Alipay's platform in the last year, ending June 30th, were 118 trillion renminbi. And China's banks are missing this wave, and that's a warning sign for banks around the world. China's central bank, the PBC, People's Bank of China, like Sweden, is now testing a CBDC. But contrary to myths that one reads in the financial press, this is not about threatening the reserve currency status of the dollar. Andres is completely right. It's not even close. And this technology will not move the needle on that. But it is true that the China CBDC may set standards for technology in this area. And by being a first mover, they get to be included in global standard setting, which is important. My country, Canada, is actually getting CBDC technology ready, but just in case paper cash starts to disappear in Canada, or in case Canada's payment system is invaded by some other digital currency. And I think that's, Canada is not so much under threat from a foreign digital currency, but I think that's a good lesson for smaller open economies. The idea of dollarization now takes a new and more threatening form if, for example, a strong, very efficient dollar-based CBDC were to become available globally. Then if I were running a central bank in a small open economy, I would start to think carefully about Canada's approach of getting ready to head that off. Most other central banks are watching carefully and they're developing plans. They don't really know what the coming disruption in payments is going to do to their commercial banks. On top of the issue of payment system efficiency, central banks are also quite concerned about financial inclusion, about monetary policy transmission, and what CBDC might do there, about data security. What if all the payments data in the economy are on one ledger operated by the CBDC, operated by the central bank? And they're also concerned about preventing illegal payments, AML, CFT, countering the financing of terrorism. And most central banks really don't want to own all of these problems. Because of that, I think CBDCs are probably, the ones that are going to get introduced are probably going to be intermediated somehow by the private sector, which will perhaps distribute CBDCs to users, provide the payment apps, and offer other payment-related services. And because of that, I think interoperability is going to be the crucial ingredient with CBDC. The biggest benefit of CBDC over normal bank rail payments is, in fact, the lack of concern over interoperability and the universal access to that payment medium. CBDCs intermediated in the private sector can go well or badly based mainly on interoperability. There's lots of good things to read on this topic. Last week, for example, BIS put out a great paper by Auer and Böhme discussing some of these issues. I assisted in a recent Group of 30 report that I actually recommend. I think it's excellent. Going forward, commercial banks are either going to disrupt their own payment and deposit franchises, or they're going to get disrupted by tech firms or by CBDC. I like the Bank of England's approach quite well, which is to provide access to central bank deposits for payment tech firms that are compliant and offer a service that's useful to the economy. The Fed is going to be grappling with issues related to this as it introduces its own fast payment system, FedNow, and as it tries to deal with fintech entrants and tech entrants to its payment system. And the complication of dealing with the mix of commercial and banking enterprise is going to be, I think, a challenge in the United States. Going forward, I think, just to sum up, I think central banks around the world are going to need to focus, and they are focusing, on a big fork in the road between improving bank-railed payment systems or introducing their own central bank digital currencies. And of course, there's a spectrum in between. And as I said, there's a really high-level, intense conversation going on in this area right now, and it's just a pleasure to watch it happen. So thank you very much, Andrew.
Thank you, Daryl. That was terrific. And as you say, I mean, that fork in the road is for real, and that fork in the road is being brought forward by events over the past few months. So thank you for setting out those issues so clearly. Dan, can I come to you to bring us home and to transform the world?
Thanks very much for that, Andy. And I will, as I'm trying to share the slides here, Daryl reminded me that in the mid-1980s, when I worked in the Treasury, monetary policy, monetary targeting was torpedoed by technological change because the new payment systems were dramatically changing the velocity of money. So it can be a really significant event indeed. I want to talk about the fantastic transformed world part of the bear, and it covers really two big topics that I'm going to pick out in my comments. One is about risk, and one is about structural change in the economy. For the 1990s, we thought that financial innovation was mitigating risk, but it turned out to be concentrating it. And in the financial crisis, we discovered that we had privatized reward, but socialized the risk. There are now many significant, potentially catastrophic societal risks facing us. The pandemic is an obvious one. I think it's wrong to call this a fat tail risk. We will get many more of these because of environmental pressures. We've got climate change and its potentially quite dramatic consequences. We've got a world where there's increasing potential conflict, also potentially catastrophic. So I think there's still a question about whether financial markets are indeed mitigating or concentrating risk. Knowing a little bit about how hard it has been to improve data collection within the UK, its timeliness and its coverage. Doing that globally is clearly a tall order. And I think simply understanding what's going on is quite a big challenge. There are also, it seems to me, some really interesting questions about what insurance markets are doing. Whenever I talk to people about the use of big data in insurance, it seems that what many insurance companies are doing is actually moving away from risk pooling. They're using the data to discriminate ever more finely between different categories of people. And that means that there are swathes of insurance coverage that some people now cannot get. This is going to drive people towards self-insurance in these kinds of areas, and there must be some implications of that too. Following on from that, if we're thinking about these catastrophic risks, do we need to think about new financial instruments, and where would that innovation come from? If you're talking about these kinds of society-wide risks, that often is the role of the authorities or the role of government. Are authorities thinking about that? Is that the only source of potential innovation? And could we also perhaps see some new kinds of institutions for risk management? If you think back to another area of transformation in the Industrial Revolution, we saw a lot of new types of institutions, including in insurance markets, but also savings markets, with the formation of mutuals and the forerunners of some of the institutions that still exist today. And if you're thinking particularly post-pandemic about the issue of resilience, do we have an institutional monoculture? Would it be interesting to think about different kinds of institutional structure? And I think this actually goes back to Darryl's points that he was making about the new kinds of entrants that might come in through technology. And finally, on risk, there's a question about monitoring and regulating, not just collecting data, but if you know that the market prices aren't pricing in these major externalities, how do you start thinking about measuring the true risk, and what kinds of steps should regulatory authorities be taking to deal with that? So that's the risk heading. On the structural change heading, one of my real questions is, what do we mean by real output? In something he wrote in 1958, Thomas Schelling said that the only real thing that we know about the economy is the nominal magnitudes, and the so-called real magnitudes are hypothetical. And that's because we deflate them through price indices. The messages we're getting from price indices now are not clear. There are a lot of new goods, there's increased variety, there's increasing price discrimination and price personalization. And there are many intangibles where it just isn't clear what the unit of quantity is. So we know what the revenues are of a sector like architecture or professional services, but we don't know the units. What is a unit of management consultancy? And just to give an illustration of this, in some work I did with colleagues at the ONS and the Institute of Engineering and Technology, we looked at alternative price indices for telecommunication services in the UK. Here's a figure from the paper. The orange line gives the current deflator that feeds through into sectoral output and productivity in the national accounts. And the lines below are the range of deflators that we looked at through more sophisticated inclusion of elements, allocating fixed costs and so on. The blue line at the bottom, the pale blue line at the bottom, is if you treat communication as a revenue with a byte as the unit, as the volume unit, and you get a unit price index, then there's a really substantial difference. ONS has recently said that they'll use the dark blue line in experimental GDP figures, and we should see before long what difference that makes. That's one sector. So I think thinking about price indices in quite a fundamental way is really important. We also worry a lot about productivity for potential output, and we've got the productivity puzzle in many countries. We analyze productivity through growth accounting, assuming that there's constant returns to scale and perfect competition. But we don't have that kind of economy. We've got absolutely pervasive increasing returns to scale, particularly in any new economy sectors, and widespread monopoly rents from banking to digital to all kinds of other sectors. So how should we start thinking about interpreting the figures through the lens of understanding what kind of economy we really have and what the implications are for productivity and potential output? And this takes you towards thinking, even as a central banker, about issues like competition policy and other institutional aspects of the economy, which are perhaps outside the traditional monetary policy arena. We've also started to think about whether or not there may be permanent reductions in potential productivity growth, partly for reasons like demography, perhaps it's for reasons of debt overhang, but also perhaps because technology innovation itself is slowing down. And Nick Bloom and John Van Reenen and their co-authors wrote a fantastic paper called Are New Ideas Getting Harder to Find? If you test this out on the engineers and physicists that I work with a lot, they will say, well, if you define an idea as one unit of something that delivers constant exponential growth, you're getting nuts because there are physical limits to that. I don't know if we are actually in the world of constant exponential growth, but if you're looking at any subset of technologies, each of those sequentially will hit those physical limits, as we're seeing with Moore's law now. But I think there's this question about, are new ideas getting harder to use? What is the potential for entry into markets? What is the accessibility of different kinds of innovation? and what is the competition environment for them. And then finally, there's a question about economic welfare linked to this point about what is real output. And if we're not thinking about a world of tangible material outputs, but instead of services and intangibles, and thinking also about the experience of the pandemic, the fact that key workers are among the lowest paid and in the most contingent jobs in our economies, thinking about the importance of access to clean air, that damage to health widely that respiratory illness can inflict, then I think as economists, we need to think more about what is it that we are trying to deliver to the people we are serving. And that takes me on to my final points, which are about some missing pieces, I think, in the transformed world agenda. It looks at distributional concerns through the lens of automation and the effects on the labour market. But I think distribution is about much more than that, including what gets innovated, who is it for, who is benefiting from all these changes. Again, going back to Daryl's points about the costs of making payments and the quality of that service. What is the location of production? Something else that's been raised by the pandemic, not just in terms of the resilience of supply chains, but in terms of what kinds of jobs for what people in what kinds of places. And then I think there's a really big set of questions about intergenerational equity. This includes environmental sustainability, which is becoming increasingly pressing. So we've got to include the economic value of nature in any assessment that we make, but also a lot of financial market aspects of it. Financial markets are about temporal issues. So thinking about the equity aspect of asset prices, pension valuations, housing markets, and so on, seems to me to be a really important part of the agenda. So I rattled through that because I know we're running out of time, but back to you, Andy. Thanks very much.
Thank you, Diane, very much for getting that through that so swiftly. All the issues you mentioned are ones that you traditionally would be seen as outside the ambit of central banks. But I think these days we cannot avoid taking them on because they bear very directly on the things that we do care about most. Now, you're right that time is short. I'd planned this bit to be a chance to take some Q&As. There are no Qs, so there can't be any As. Except I think maybe I can use my chairman's prerogative to perhaps lob to each panelist in turn a question, if I may. And the question I'd like to ask you is, if you, from the basis of what you heard from the panel discussion, could each of you pick out from the other presentations what would be the one issue that you think we ought to prioritize as part of our research agenda if we're going to make real progress on a really big and pressing public policy question? If you were sitting in my shoes making a choice among these vast array of fascinating and important issues, where would you be putting your chips right now? I wonder whether I could come to Andres first to ask for your single wish, Andres.
Or that's a very big ask without having thought about it much. I will take the easy way out and mention two briefly. One is something that Viral emphasized. I am not a big fan of seeing moral hazard behind everything, but it is the case that we have created the expectation in markets that central banks will stand behind asset prices. And not just asset prices, but the integrity of a lot of contracts, which may or may not be welfare improving. Clearly, this is not an easy subject for central banks because it is easy to say ex ante, I will refrain from intervening when the time comes, but of course, ex post, when you're under a lot of pressure, it is very hard to refrain. It's a classic time inconsistency problem, but it is simply one that I think has become all the more acute recently. And then from something Diane said, central banks are supposed to be about the cyclical, not about the structural, but it is very hard to tell both apart. It seems to me that the implications of technological change plus changing patterns of globalization plus the pandemic is going to wreak havoc with the structure of labor markets in lots of places. And maybe the market will sort it out after 5 years, but during those 5 years, we could see some ugly things happening in the labor markets, and central banks will find it very difficult simply to look the other way. Exactly what you do when the subject is not necessarily an aggregate demand problem is not clear, but it is something for central banks to keep in mind.
Andres, thank you for that. Can I go to Viral for your suggestion, Viral? You're muted, Viral.
Yes, sorry. I wanted to take one of the ideas that Andres highlighted on, what is a scenario in which we start questioning the reserve currency status or the fiscal stability of the US dollar safe assets. I know it's probably an extremely low likelihood event, but I think central banks should run some war rooms which try to think about what is the sequence of steps or outcomes that might lead to such a scenario, and when it plays out, what happens. I think it's probably very complex, but I feel that we've got to start thinking about some scenarios in which this happens. And I think the main reason why I put this on the table is because of what Andres stressed, because I think the politics is just not looking like developed country politics anymore. And I think then you have to entertain that emerging market style outcomes might be on the table.
Thank you, Viral. Daryl?
Well, I'm also intrigued about this issue of the reserve currency status of the dollar and in general, the role of international finance. And I see us at a very difficult time with respect to the role of the dollar in international capital markets at a time at which China and the US are at loggerheads. The amount of security concerns that they have about each other is causing them to start to use capital markets, particularly the United States just recently, as a foreign policy a tool. I won't call it a weapon yet, but it's starting to look a bit more like a foreign policy weapon. And I think that's a very dangerous situation. For example, there have been suggestions that the United States should use its payment system as a way to apply pressure in the international stage. And of course, a country's national security comes first above all else, but this can boomerang to the detriment not only of globally, but also to the home country, because the reliance on the dollar as a global reserve currency depends in part on the belief that everyone has access. And it hasn't come to the stage yet where access is strictly and directly threatened, but it's starting to look to be headed in that direction. And so that is a concern that I have had recently.
Thank you, Daryl. And Diane?
I think I would go for Daryl's set of questions about central bank digital currencies and their role in setting standards and enabling access to enable new entrants based on new payments technologies. We saw with mobile payments in East Africa and South Africa what a significant real economy impact improvements in the payment system can have. And I think it's time to use the technology to democratize that and end the rent seeking.
Thank you, Diane. We're into overtime, so I should definitely bring things to a close. That's been an absolutely brilliant session and tremendously rich presentations. I've taken pages and pages of notes, and my colleagues at the bank will be picking up, I hope, many of those themes, and I hope also coming forward with research proposals on them in the years ahead. So meantime, let me just thank our four panelists for their presentations today, to Andres, to Viral, to Daryl, and to Diane, thank all of you for listening in and contributing, and to hope that looking forward, today's discussion can be the basis for increased external collaboration between us at the Bank of England, indeed central banks generally, and the academics, both on this panel and more broadly. So thank you all for your time, and enjoy the rest of your day. Thank you.
Thank you, Andrew.
Thank you, Andy. Thank you, everyone. Bye.
Thank you, everyone. Bye-bye.
Bye.
Thank you.